Tertia Jacobs is a Treasury economist at Investec. Tertia, good afternoon to you. Do you agree with the Statistician General? Was it about the load shedding and about the floods over Easter? Are those some of the factors that saw our economy shrink in the second quarter?
Definitely, Stephen. And then it was also exaggerated by the COVID lockdown restrictions in China. So, both the Chinese and the U.S. economies contracted in the second quarter, and then that just sort of compounded the impact on exports, which also slowed down significantly.
Well, this shows you we're not really in charge of our own fate, are we? China again going into a lockdown, 33 million people in a semi-lockdown. That was announced today. What's happening there seems to be having a huge impact on us.
Absolutely, because it depends very much on the region where the lockdowns transpire, So like in April, May, it was Shanghai, which is also a huge production hub, and that had supply chain disruptions. And obviously, China's a big destination for some of our commodity exports. So it tends to have a major impact on volumes. And also we have seen a moderation in commodity prices, with global demand slowing, with China's, especially the real estate sector, under significant pressure because of reforms.
Is it possible to sort of untangle from the numbers what are the issues with China, what are the issues with load shedding here? The flood is something we don't really have control over. You could argue with climate change we do, but we don't for the moment. What I'm trying to get to is it possible to put a figure on what load shedding is costing us in terms of economic growth?
Towards the end of June, we moved to stage 6 load shedding. Now, stage 2, stage 4 was estimated to cost the economy around about 900 million per day. And stage 6, we're guessing here, but it's closer to about 1.5 billion plus today. And then obviously the indirect consequences is the effect it has on confidence, because, very few people will be willing to invest more if you're not sure about electricity supply going forward. So that can perhaps, continue to reverberate. We did see private sector fixed investment ticking up a bit in the second quarter. But, what will the momentum be going forward? Then it's very difficult, I think, to untangle the Chinese and the electricity story on the mining side. Mining production has not yet returned to pre-COVID levels. And, part of the reason is obviously the electricity supply constraints. The fact that the Department of Minerals and Energy is very slow to give the green light for many new mining projects to go ahead. And then, of course, the big hit that exports or mining exports get, bulk exports via the rails, because of the manifold challenges faced by Transnet, and then also port capacity. And then, so that hit as that's the front line that gets hit. And then on the other side of the coin is obviously demand for our exports. So it's a bit of a production issue as well as a demand issue.
I suppose in a way what this also boils down to is there are a lot of things we can control. We should be able to control what happens with our oilways. We've lost control a little bit of our electricity network. We're trying to regain control of it through the presidential announcements. The Minerals and Energy Department could move a bit more quickly in terms of mining licenses, prospecting licenses, and, dare I say, energy production licenses. Those are all things that could make a difference if we got going with it.
Definitely, Stephen. So as you're pointing out, since stage 6 load shedding, the liberalization of the supply side, very important. Over the next, I would think, 12 to 24 months, we can start to address the 6,000 megawatt shortfall. But then again, just very important, this 6,000 megawatt shortfall, that is in line with the current growth rate of the economy. It doesn't factor in an acceleration in growth, right? So very important that there's a lot of urgency attached to getting new capacity over and above 6,000 on the grid as well.
We're seeing a lot of things around the fuel price at the moment, and just the price of energy. And the price of energy can often have a huge impact on your entire economy. It impacts how much it costs people to get to and from work, but it affects what people are actually able to do. This is going to be a big factor in Europe this coming winter, I think, because of the price of energy. Fuel prices beginning to go down here. Do you think that that's going to be a factor going forward at all?
A couple of issues. So number one is, we're very grateful for the R2.04 litre reduction we're getting from tonight. But very interesting is that the diesel price will only decline by 50 cents per litre. And internationally, we've seen your refined oil prices coming down more than your diesel prices. So the reduction in the fuel price will be more beneficial to consumers. And, it's not inconceivable that we can get at least another R1 reduction in October because the daily over-recovery is quite substantial. But I think the positive consequences for the business sector, which tends to utilize more diesel, will be less. And that feeds into transport costs, into food price inflation, and so on.
What's going to happen in the third quarter? I mean, do you expect this trend to continue, or do you think that maybe we'll bounce back a little? Of course, when you contract in one quarter, the risk is that you may contract in the second quarter and have a technical recession.
So that is what we're busy assessing. So the incoming data for the third quarter. So far we saw quite a nice rebound in new vehicle sales, although part of it is to do with Toyota bringing production back online after being affected by the April flooding. That's point one. Point two is, there could be a bit of a rebound, as stage 6 load shedding has that was ended, but as you pointed out, load shedding will continue again this week, but at the margin perhaps a little bit less. So, but the other thing that we're monitoring is this week we're getting consumer and business confidence from the BER for the third quarter. And the reason why these indicators are quite important is, with inflation relatively high, although we do expect it to have peaked in July with a lower oil price starting to come through, interest rates are rising. So, there is a lagged effect between high interest rates and how it affects disposable income. So that is something that we will monitor. And then the second issue is the business confidence, because, after the stage 6 load shedding, the announcements with regards to energy reform from President Ramaphosa, and whether that could start seeing business confidence turning a corner, because that's absolutely critical, if we're going to see an improvement in employment. The business fixed investment and employment creation go hand in hand.
We've been talking.
So it's still.
Go on.
No, it's still early days, but it would be very encouraging, at least if business confidence could start bottoming out.
We've spoken a lot about China in this conversation. The EU, also a major trading partner for us, so is the UK, so is the US. All of those economies are in a very interesting space. I mean, the US has a very low unemployment rate at the moment and yet very high inflation. The UK has very high inflation. People in Germany are very worried about energy prices there. Is that all going to have an impact probably over the next 2 years for us?
Yes. You can also reason the FOMC is in a more comfortable position than the ECB, because there the FOMC has to hit demand very hard, because that is actually a big driver of inflation, whereas the ECB has to deal with high inflation, a war, very high energy prices, which are pushing up living costs, and they have to start normalizing interest rates. And you can also throw Italy into the pot, which has very high debt levels. So the ECB is also trying to contain their costs. So it's very challenging. So I think the big risk at the moment is, and that's also a driver of the very strong dollar. So, there's a couple of drivers of the dollar. So it's the Fed hiking rates more aggressively than the rest of the world. Secondly, it is the risk of a European recession that is also leading to a weaker euro. So how it's impacting South Africa, aside from global trade that could moderate as well, is that the rand is relatively strong against currencies such as the pound, such as the euro, who's also losing ground against the dollar. So, but all currencies are relatively weak against the dollar. But yes, I think the next big dynamic that's going to unfold, because, with central banks sort of coordinating action to combat inflation, is there will be a price, and that will be slower global growth.
I mean, our Reserve Bank's also going to increase rates again. I'm almost certain. I think everyone is certain of that. There's been some commentary from a bank. They're a competitor of yours, so I won't name them in front of you, Tertia. They suggested a few weeks ago that inflation may have peaked in South Africa. Prices will still go up, but not as dramatically. Do you agree with that assessment?
Yes, Stephen. So we think that inflation has peaked at 6.9% in 7.9% in July. So likely to hopefully coming down to about, we think, about 6.5% by the end of the year. But then very important, where is inflation going into next year? So I think that the headline numbers are turning a little bit more encouraging, with the big drivers such as oil, hopefully food price inflation beginning to moderate. But then what the Reserve Bank will also be watching is what's happening to core inflation. And then what we're watching there is, pass-through effects from the weaker rand, what's happening to inflation expectations, because, it's inflation expectations that tend to propagate, inflation going forward, which plays out in what happens to wage increases. So the man in the street do wish to be compensated for higher inflation, but then that is also adding to input costs of companies which are already under pressure. So it's a very difficult operational environment faced by companies.
Tertia Jacobs, thank you so much. Treasury economist at Investec. Really do appreciate the time.